The information gleaned in this course is based on my real experiences. I write all my business plans using a free downloaded business plan template I modified and gave to viewers for free. The ideas and suggestions used in this course are based on business plans submitted to traditional banks. Other types of lenders may want to see different information in a business plan if they want to see a business plan at all. In any situation, regardless of what type of lender is selected, always contact the lender directly and ask questions. Objectives. Business plans are essential tools for guiding a business from its inception through its growth and development. A well-written business plan helps business owners, investors, and stakeholders make informed decisions, set and achieve goals, and adapt to changing circumstances in the business environment. When it comes to banks and other lenders, they may require a business plan to assess the credit worthiness of the business seeking the loan. The business plan helps the bank understand the business's financial stability, strategy, and management capabilities, all essential factors in making lending decisions. A well thought out and prepared business plan can significantly improve the chances of securing financing from a traditional bank. This mini course focuses on writing business plans that will be submitted to a traditional bank and is an overview outlining critical information you need to write a winning business plan. This mini course will outline the following tips. When to delay your business plan, especially if you're paying for it. Should the 2020 pandemic be discussed in your business plan? Credit reporting changes and how they affect credit scores. Getting started, my tips for writing a winning business plan. Submitting a business plan to a lender in 2022, my story. When to delay your business plan, especially if you're paying for it. A great business plan does not guarantee a business expansion loan. Before paying someone to write a business plan, it's helpful to understand the reasons why a bank might reject a business loan application. When a decision has been made to begin moving forward with business expansion, contact the bank or lender in advance and discuss what specific information the bank is looking for in said business plan. Based on my experience, here is a list of issues that may cause a traditional bank to add stipulations to a business loan or totally reject a business loan application. If any of the following scenarios exist, writing a business plan may be pointless, and if the business plan writer is monetarily compensated, it would be a waste of money if any of the business owners checked yes to one of the following. This is not an all-inclusive list. Back child support. Child support payments are a legal obligation, and the failure to meet these obligations can lead to legal consequences. Banks are typically concerned about lending to businesses or individuals with unresolved legal issues, as it can result in legal actions or judgments that could impact the borrower's financial stability and ability to repay the bank. If any business owner pays child support, I highly recommend verifying that all payments are current with the Attorney General's office in the state where the support order was granted, and request a statement confirming payments are current. Low personal credit score. A low personal credit score can signal financial instability and unreliability in meeting financial obligations. A bank may view a low personal credit score as an indicator of potential risk in managing business finances. Some banks may grant the business an expansion loan with a low personal credit score, but the bank may require either collateral and/or the interest rate may be higher than normal. Unpaid taxes. Unpaid taxes may lead to the government placing a tax lien on the business assets. Unpaid taxes and tax liens can give the government a legal claim on the business property and assets, which take precedence over the interest of other creditors, including the bank. This makes it riskier for a bank to lend to the business because in the event of default, the government may seize the collateral before the bank can recover its funds. Not just federal. This includes personal, business, franchise, state, and local taxes. High debt to income ratio. Banks use debt to income ratio to assess the financial risks of the borrower. If a significant portion of the business income is already committed to debt payments, this could raise concerns about the borrower's ability to pay the bank. A high debt-to-income ratio may also be a sign of financial instability, increased risk of default, and a reduction in the borrower's capacity to pay the loan back. In addition, banks must adhere to regulations and lending standards designed to protect financial institutions. Lending to borrowers with high debt-to-income ratio may expose the bank to regulatory risks and potential legal issues. Past due personal or business debt. Past due debt indicates potential financial distress, which may reduce the business's capacity to generate the necessary revenue to repay the loan. Past due debt also increases the risk of loan default. Banks aim to minimize their exposure to default risk, so they may be reluctant to lend to businesses with unresolved past due debt, both business and personal. Further, banks prefer to lend to businesses with strong credit profiles and a good track record of meeting their financial obligations. Unpaid or past due government secured loans. In addition to banking regulations and lending standards, government-backed loans are often subject to strict terms and conditions, and failure to meet these obligations can result in legal action and the government exercising its right to recover the debt, which can take precedence over other creditors. Banks want to avoid getting entangled in legal and regulatory debt. Government-secured debt includes student loans, paycheck protection loans, also known as PPP loans, and EIDL loans granted during the pandemic of 2020. Cosigner on loans. Shared liability on a loan co-signed by a business owner may impact debt-to-income ratio, which banks use to access a borrower's ability to repay a business loan. Banks want to be certain that the business owner's financial resources are not unduly encumbered by co-signed loans. Also, banks may consider the co-signed loan as an existing financial obligation, and if it pushes the business owner's debt-to-income ratio above the lender's criteria, it could result in loan rejection. Legal claims and judgments. It's crucial to address and resolve legal claims and judgments and demonstrate a stable financial situation when seeking a business expansion loan. This can improve the likelihood of loan approval and contribute to the overall financial stability and growth of the business. In addition, all business owners must have the following information, or a traditional bank may not accept the business plan. 3 years of business tax returns, 3 years of personal tax returns, 3 years of business financials, profit and loss and balance sheets, 3 months of the most recent company bank statements, disclosure of any prior government loans, PPP, EIDL, SBA, Community Advantage, SBA Express, certain student loans, and other debt with a government guarantee. Overall, the bank's goal in requesting 3 years of financial statements is to perform a comprehensive risk assessment and determine the business's ability to repay the loan. Providing the historical financial information demonstrates your business's stability, trend analysis, financial management capabilities, and long-term potential, which can strengthen your loan application. The actual number of years may vary from bank to bank. I've seen where some banks only ask for 2 years of returns and financials. My suggestion is to always include 3 years. That way, the process is not slowed down if the bank says to submit 2 years of everything, but the underwriter wants to see 3. Should the 2020 pandemic be discussed in your business plan? If you're writing a business plan, especially if you're going to submit it to a traditional bank, here are my tips on how and if the 2020 pandemic should be addressed. The COVID-19 pandemic had a profound impact on businesses globally. It disrupted markets, supply chains, customer behavior, and more. Mentioning the pandemic in your business plan provides context for your business's situation and timing, which can help the bank understand your business environment. Discussing the pandemic allows the business owner to outline its strategies and contingency plans in place to mitigate risks and uncertainties. It demonstrates that the business owner considered the potential for future disruptions and are prepared to address them. The pandemic may have changed customers' needs and expectations. Mentioning how the business adjusted to meet these changing demands can demonstrate that the business owner is in tune with its customers and can adapt to market shifts. The financial impact of the pandemic may be evident in the business's financial projections. Explaining how the company adjusted its revenue and expense forecasts in response to the pandemic's effects can provide a more accurate picture of the company's financial outlook. Investors and lenders value businesses that have learned from past crises. Discuss how the company integrated lessons from the pandemic into its business strategy and preparedness can build a confidence in the business owner's ability to navigate future challenges. Being upfront about the pandemic's effects on the business can demonstrate transparency and honesty, which are valuable traits when seeking financing or partnerships. If the business pivoted successfully during the pandemic or identified unique opportunities, this can be a point of differentiation and a potential competitive advantage. Sharing these successes can make the business plan more compelling. Discuss if the business was classified as essential throughout the pandemic. The classification of your business will determine if your business will be open or closed should the country shut down again due to another pandemic or anything else that could happen. A business classification of essential may provide some assurances to the bank that there will be minimal interruptions in your business should for some reason the country shuts down again. Did your company receive a Paycheck Protection Program or PPP loan? If the answer is yes, the bank may have some concerns regarding how the company will survive any temporary work stoppages or may not be able to survive a difficult time like a shutdown. If a business received money from the PPP program and the business later applied for an expansion post-pandemic, the business plan should discuss why the decision was made to apply for PPP or similar funds. The company's strategy for getting through hard times should also be discussed. If the business was closed during the shutdown, was the business able to meet its financial obligations? Did the business close but was able to continue producing its goods and/or services? Were the clients late paying invoices? Was the company able to pay all of its bills on time? Were any employees laid off? Did the company pivot to using subcontractors? Discuss the company's profit and loss during the 2020 pandemic. Did the company's profits return to pre-pandemic levels? How long did that take? At the end of the day, the bank is carefully examining its risks as it relates to business funding, especially during the post-pandemic period. While discussing the pandemic is important, it's also essential to strike a balance. Don't dwell on the challenges, but rather emphasize how the company adapted and what was learned. Tailor the discussion to the company's specific business and its response to the pandemic's impact. Credit reporting changes and how they affect credit scores. Let's take a look at 5 credit reporting changes the business owners should be made aware of. These laws went into effect July 1st, 2022. Paid medical collection debt that was turned over to a collection agency and eventually satisfied will no longer appear on consumer credit reports. Individuals will now get a full year to work out insurance or billing issues before unpaid medical debt is reported on credit files. In the first half of 2023, the Big Three will start omitting all medical collection debt under $500 from credit reports. If a business owner uses buy now, pay later installment accounts, these accounts are now added to credit files and may be considered as a short-term loan. Each buy now, pay later service may result in a hard credit inquiry, which can have a temporary negative impact on a business owner's credit score. Multiple credit inquiries in a short period can be a red flag to the bank. Some buy now, pay later providers report payment histories to credit bureaus while others may not. If the business owner's buy now, pay later transactions are reported, the payment history, including any missed or late payments, can affect the business owner's credit score. Let's talk about the FICO 10 credit scoring system. I highly advise business owners and business plan writers to inquire about the FICO 10 credit scoring system and will it be used by the lender. FICO 10 debuted in January 2020 before the pandemic. Here's the short version. Lenders that have adapted the F10 model of credit scoring will use trending data instead of the one-time snapshot review of credit history. Credit information for a business owner can be reviewed over a period of months or even years to review debt patterns. It may not be enough to just pay off your bills. An astute business plan writer will understand the ramifications of F10 credit scoring and will advise the business owner accordingly. Getting started. My tips for writing a business plan. When my client and I approached the bank for funding in 2022, we asked the branch manager a series of questions. The bank specifically informed us they were not interested in funding a new venture. The bank was interested only in funding businesses that have strong history and strong financials. As a business plan writer, keep in mind that banks in general will not fund any venture 100%, regardless of how great the business owner's credit score. The bank wants to see that the business owner has some skin in the game. At the most, the bank funded my client 90%, and he had excellent credit. And if I must admit, a great business plan. Depending on the lender that's asking for the information, business plans are never the same. It may not be necessary to complete a comprehensive business plan with hundreds of pages where the writer must compute figures using complex charts and graphs. The complexity of the business plan depends on what information the bank wants to see and what the business plan writer knows what to add. Keep in mind that the bankers and underwriters would like to be able to quickly extract information, not sift through thousands of pages. In my client's case, the bank asked that I create a simplified plan that includes the following: a resume for all business owners and key employees, a description of the current business and its services, a plan for the company's next step of expansion and services that will be provided post-expansion. If equipment is part of the company's expansion plans, it should be noted what type of equipment will be purchased. The bank also asked for a simple projected dollar amount stating business revenue that the expansion will generate. The bank specifically informed us that no detailed graphics or anything similar is needed. This is why it is important to maintain clean financial records. If a CPA and/or an experienced bookkeeper is hired, it is worth the investment since the bank is expecting to review accurate financials. If necessary, the business owner may be required to respond to questions based on those financials. If you are a business plan writer, take the time to triple check the information you are giving a financial institution. Submitting a business plan to a bank is a critical step in seeking financing for a business. Before submitting a completed business plan, make sure final checks have been performed to ensure the business plan is well prepared. A well-prepared business plan increases the chance of loan approval. Here are some key checks to consider. Grammar and spelling. Proofread the entire document to eliminate grammar and spelling errors. Mistakes can detract from the business owner's professionalism. Consistency. Check for consistency in formatting, fonts, and style throughout the plan. A polished, uniform appearance is more appealing. Clarity and structure. Ensure that the plan is well organized and follows a logical structure with a clear and concise executive summary, market analysis, financial projections, and other relevant sections. Relevance. Confirm that all the content in the business plan is relevant to the business and supports the business owner's goals. Remove any irrelevant or unnecessary information. Market research. Double check the accuracy and relevance of the market research. Ensure that the most current data available has been used. Financial projections. Review financial projections to ensure they are realistic and backed by sound assumptions. Make sure the financial projections align with the rest of the business plan. Spelling out acronyms. If acronyms or industry-specific jargon is used in the business plan, be sure to spell them out upon first use and provide explanations as needed. Factual accuracy. Verify that all facts and figures presented in the plan are accurate. Any inaccuracies can undermine your credibility. Risk assessment. Acknowledge potential risks and challenges the company may face. Address how the business owner plans to mitigate them in the business plan. Legal and compliance issues. Make sure the business plan adheres to all legal and regulatory requirements. The business plan should be in compliance with applicable laws and regulations. Clear and concise language. Use clear and concise language to explain the business's concept and financials. Avoid unnecessary jargon and overly technical terms. Executive summary. Ensure the executive summary effectively summarizes the key points of the business plan in a compelling manner. Appendices. Review any supporting documents in the appendices such as resumes, contracts, or market research data to make sure they are relevant and well organized. Team bios. Check the bios of key team members to confirm they highlight relevant experience and qualifications. Exit strategy. If applicable, include a well-defined exit strategy for the bank's benefit. Third-party review. Consider having a trusted advisor, mentor, or business consultant review the business plan for feedback and insights. Financial statements. Ensure all financial statements are accurate, consistent, and include balance sheets, income statements, cash flow statements, and any other required financial documents. Ensure the business owner's various tax schedules and personal finance statements are in proper order. Appendix table of content. If the appendix contains multiple documents, include a table of contents for easy reference. Executive presentation. If you plan to present your business plan in person, rehearse your preparation and make sure it aligns with the content in the written plan. If a business consultant will accompany the business owner to the bank, it should be the business owner leading the discussion and responding to the questions. The business consultant is there for the purpose of support and to clarify any responses if needed. Bank's requirements. Check if the bank has specific guidelines or requirements for business plans. Ensure that the business plan complies with their expectations. Regardless of what type of business plan you are going to write, ask questions before you start. I think it's worth the business owner's time to have a preliminary meeting with the financial institution and ask, what type of business plan is needed? What specific information does the lender want to see in the business plan? If the bank requests a simple business plan, keep in mind what information the writer believes is important for the success of the business plan. The person who is saying, submit a simplified plan, may not understand that a simple business plan is insufficient for the underwriter. Ultimately, it is up to the business plan writer and the business owner to decide what information goes into the business plan. Submitting a business plan to a lender in 2022. My story. My client and I met with the bank twice. The first meeting was very informal and lasted less than 20 to 25 minutes. This is when we submitted the completed business plan. While my client and I were discussing the company with one bank executive, another bank executive immediately thumbed through the business plan, going straight to the financials. The bank executive spread out the 3 years so they could be viewed together. After about 30 to 45 seconds, the bank executive slightly nodded their head. At the conclusion of this first meeting, the bank executive said they would review the business plan and the other documents and would be in touch. A week later, we were contacted again by the bank, who requested a second meeting. The second meeting was very formal. There were 3 bank executives in this meeting along with my client and me. At this stage, the bank had already read the submitted business plan and reviewed the financials. The second meeting focused primarily on my client's vision for his company and any questions unanswered in the business plan. The business owner should be ready to discuss the business in detail with the lender. Prior to this second meeting, it is a good idea to coach the business owner and help with cultivating responses to anticipated questions. My client did 90% of the talking. As the business consultant and business plan author, I only responded to questions when a clear response was not provided. The financial projections and bank products, like lines of credit and credit cards, were also discussed. Other topics discussed in depth with the bank included discussing the uniqueness of the business and how the business has set itself apart from the competition. The bank wanted to confirm the breakdown of how the expansion loan would be used: equipment, vehicles, salary, real estate, etc. This information helps the bank determine what products to offer. The bank discussed the differences between the various lines of credit. The bank let the business owner know about equipment loans, vehicle financing, and commercial real estate loans. We received various documents that outlined interest rates and interest rate comparisons for various commercial real estate loans. The bank representatives must be satisfied with the business plan, supporting documents, and the business owner's responses to their questions before the next step. The next step was to forward the business plan and other supporting documents to the underwriter. In my experience, the business owner does not meet with the underwriter. The underwriter reviews their findings with the bank representatives and asks questions. The bank representatives convey any findings or ask any additional questions on behalf of the underwriter. Despite what any bank executive says, it is the underwriter that makes the final decision on the business expansion loan. Once funding is approved, the money may be divided between various bank products. For example, if a building will be purchased, the commercial mortgage department will take over. If equipment is needed, the bank will offer their terms and interest rates and transfer the funds to the equipment company. In other areas of funding, the bank may determine a line of credit or a credit card may be necessary. There will be no Scrooge McDuck moments. The bank will not flood the business owner's bank account with money. All of the scenarios outlined in this video will be discussed either in your business plan or during one of several meetings with the bank and its team. Addressing tough topics in your business plan head-on will show the bank and the underwriters that the business owner has carefully examined its crisis management strategies during the pandemic, as well as the company's fiscal performance. In addition, the bank will have some assurances that these areas have been examined. If the company's business plan is light on information, I guarantee the bank will have more questions and ask for more meetings. At the end of the day, the bank wants to get their money back and see that they are lending funds to a company that consists of forward-thinking strategists and professionals. If you want to know more about business operations, business management, human resources, and other topics related to running a business, click on one of those play links. Click on one of these click on the playlist.
One eternity later.
Click on one of these playlists. Thanks for watching. And don't forget to subscribe.